So, you've decided that you should probably start investing. And then you actually look into it, and it's a wall of jargon. Index funds, ETFs, expensive ratios, Roth IRAs. So you close the tab and tell yourself, you'll figure it out later. If that's you, you're in the right place. I've got you. But that figure it out later is costing you more than you think. And it has nothing to do with how much money you start with. In this video, I'll take you from knowing nothing to owning your first share. What to buy, the 2 things to sort out before you put in $1, and how to make that first purchase. And that cost I just mentioned, it comes down to about 10 days. By the end, I'll show you what 10 days looks like in real money, with 2 people who each put $10,000 in the market 20 years ago. And one of them walks away with $71,750, while the other one lands at $32,871. Less than half, just for missing those 10 days. So let's back up to the money you already have, sitting in savings, doing nothing. Or at least, that's what it looks like. Think about what you spent on groceries last week. Now think about what that same cart would have cost you 3 or 4 years ago. It's not close, is it? Rent's up, gas is up, a night out costs more than it used to, and for most people, the paycheck hasn't kept pace with any of it, which is the squeeze everybody's feeling and nobody can quite point at. That's inflation. Prices climb every year, and the money you're holding on to buys a little bit less. The balance in your account never moved, so nothing looks wrong. That's why it slips past you. So sitting still has a cost. It's a slow leak, and the only way to plug it is to get your money growing faster than prices are climbing. Good news is, it's just math. Nothing clever about it, and there are really only 2 ways it happens. The first one is ownership. When you buy a stock, you're buying a tiny piece of a real company. Take a name like Apple. When Apple sells more iPhones and earns more money, the whole company gets more valuable. And if you own a share of it, your share gets more valuable too. That's the entire idea. You own a piece of something real, and you rise when it rises. The second way is the one that does the heavy lifting. It's called compounding, and it sounds boring right up until you watch it move. Here's how it works. Your money earns a little money. Then that new, slightly bigger pile earns money too. Then that earns money. It's a snowball rolling downhill. Tiny at the top, but the further it rolls, the faster it grows, because there's just more of it to grow. Let me show you the math on it, because it's simpler than you'd think. Say you put in $1,000 and it grows about 10% a year, which is roughly what the market has averaged over the long run. Year 1, you earn $100. Now you've got $1,100. Year 2, that 10% is working on the bigger pile, the $1,100. So you earn $110. Now you're at $1,210. And it just keeps going like that. Year 3 earns you $121, year 4 $133, and by the end of year 5, that original $1,000 would sit at around $1,610. And you've never added a single dollar to it along the way. Every year, the amount you earn gets bigger on its own. That's the snowball. And this is only a 5-year example. Stretch it across decades, and you'll see exponential growth. Now, see what's actually doing the work here? It's the time, way more than the money. The snowball only grows because it keeps rolling. Remember that one. It comes back at the end and it decides everything. So go back to that same $1,000 sitting in savings. 2 paths. On one side, it stays put. And every year, inflation shaves a little off what it can actually buy. So a few years down the road, it's worth less than the grand you started with. On the other side, it's invested and compounding, projected to climb past $1,600 and keep going. The saver didn't play it safe. The saver slid backwards. That's the real cost of doing nothing. You go backwards. So if letting it sit is the losing move, the question becomes what you actually put it into instead. And this is where a lot of beginners take a wrong turn right out the gate. Here's the instinct almost everyone has. Find the hot stock, the next big thing, buy it before it takes off and get rich. It feels smart. It's usually disaster though. Let me show you why. Remember Peloton? During the pandemic, everybody wanted one. The stock ran all the way up to around $162 in early 2020. And today, it trades under $7. If you'd bought near the top feeling great about yourself, that's your money gone. Or Beyond Meat, the future of food, remember that? It spiked to about $235 back in 2019, and today it's a penny stock trading under $1, around 60 cents. From the future of food to pocket change. Nobody saw either of those things coming, and that's the whole point. You can't reliably pick the winners, because the people whose literal job is picking winners can't do it either. That doesn't mean every stock is a trap. It means betting your future on guessing the one right company is a coin flip you never have to take. So here's the smarter move. Skip the guessing entirely and buy all of them at once. And you can do that with something called an index fund. An index is a list of companies. The S&P 500? That's a list of the 500 biggest companies in America. Your Apples and your Microsofts. And a fund is just a big pot of money from lots of regular people that goes and buys the whole list. So when you put money into an S&P 500 index fund, you own a tiny slice of 500 companies at once. If one of them tanks, your portfolio doesn't get a massive hit. You've got 499 others carrying the load. That's diversification. Your eggs are spread across hundreds of baskets instead of balanced on one. Now, you'll also hear the word ETF thrown around. And beginners get tripped up thinking it's some separate thing. It really isn't. An ETF is just the form most index funds come in these days. It trades like a regular stock, so you can grab a single share whenever the market's open. An index fund is the strategy. ETF is the packaging. Same idea underneath. For a total beginner, the one I'd point you toward is called SCHD. It's an ETF that charges a rock-bottom fee of 0.06% and tracks a list of about 104 solid, dividend-paying American companies. Quick heads up, so I'm being straight with you, SCHD isn't the S&P 500. It's a slightly different flavor. It leans towards companies that pay you a dividend, which is real cash that lands into your account. And when you're just starting out, watching actual money show up is a pretty great reason to stick with it. And the tiny fee number matters way more than it looks. Let me put real dollars on it. Say you've got $10,000 invested. A 0.06% fee, like SCHD's, costs you $6 a year. Now, a fund charging 1%, that's $100 a year. Every year, on the same 10 grand. Doesn't sound like much either, right? But if you invest over 30 years, the cheap fund would take about $180 from you the whole time. The 1% fund would take around $3,000. Same money, same market, you just handed one of them almost $3,000 extra. And honestly, that's the floor. Because as your money grows, that 1% is taking a bite out of a bigger and bigger number every year. Run it on a real growing account, and the gap climbs into the tens of thousands. That yearly fee has a name, by the way. It's the expense ratio. It gets pulled out automatically, so you never actually see it leave, which is exactly why people ignore it. One more thing, because it trips people up constantly. Buying SCHD and VOO and SPY doesn't make you 3 times as diversified if they're all holding the same companies underneath. Funds overlap all the time, so know what's actually inside the thing you're buying, not just the ticker on the front. So before you buy any fund, run 3 quick checks. Does it track what you actually want to own? Has it been around long enough to have a real history? And I'd want at least 10 years on it. And is the fee nice and low? Nail those 3 and you're in good shape. We're about halfway through this. You've already got the why and the what, and those are the 2 hard parts. What's still sitting at the end are those 10 days that could be the difference between taking home all of it or half of the return. I'll show you exactly when they turn up. Now, as much as I want you investing, there's a version of this where putting money in is the wrong move. 2 versions, actually. The first one is high-interest debt, credit card debt especially. Look, if you're carrying a balance, here's the reality. The average credit card right now charges about 22% interest, and plenty of cards run higher. Now put that next to investing. The market averages around 10% a year over the long haul. Your credit card is charging you more than double that every year, guaranteed. So wiping out a 22% balance is the closest thing to a sure win you'll ever get. Nothing in investing comes with a guarantee. That one does, and it's already sitting in front of you. The second one is an emergency fund. 3 to 6 months of expenses parked somewhere safe and boring where you're not tempted to touch it. And yeah, I know, that's the advice everybody nods at and then skips. But stay with me on this one because it's the thing that protects everything you're about to build. Here's why it matters so much. Life happens. The car dies. The job vanishes. The rent's still due Friday. If you've got no cushion, you're forced to sell your investments at the worst possible time, right when they're down, just to cover the basics. And that right there is how an investor turns into a panic seller. The emergency fund is the thing that lets you leave your money alone when everything gets scary. Keep that point in your back pocket because it shows up again later and it decides more than you think. One last rule, and it's a short one. Only invest money you won't need for years. And if you're saving for a house next spring, that money stays out of the market. Stocks swing around hard in the short term, and you never want to be in a position where you have to sell on a bad day. So, clear the debt, build the cushion, and then the money you put in finally gets to do the job you're putting it in there for. So, that's the boring half out of the way. And the part everybody actually dreads, that is buying the stocks, only takes a few minutes. Let me walk you through the entire thing, step by step. Step 1. Pick where. You need a brokerage, which is just an account that lets you buy and hold investments. The easy, trusted names are Fidelity, Schwab, and Vanguard. If you're outside the US, Interactive Brokers is a great option. Any of them work fine, don't overthink this one. Step 2. Pick your account type. You've basically got two choices, a regular brokerage account or a tax-free one called a Roth IRA. The regular brokerage account is fully flexible. Pull money out whenever you want, no rules about it, but you'll owe some tax on your gains. The Roth is where the big perk lives, because your growth comes out tax-free, and the trade is that the growth is meant to stay put until you hit 59.5. If you're starting young and thinking long-term, the Roth is tough to beat. Step 3. Open it. It's just a form. Your name, address, social security number. Takes about 5 minutes. Same as any account you've ever set up online. Step 4. Put money in. You link your bank account and transfer some cash over. That's it. Step 5. Find your fund. There's a little search bar. You type in the ticker, SCHD, and it pops right up. Step 6. The actual buy. One share is around $32.75. You type in how many shares you want, or just how many dollars you want to spend. Pick a market order, which simply means buy it at today's price. Keeps everything simple. Then you hit buy. Done. Step 7. Look at what you now own. Open up the holdings and you'll see real companies sitting there in your account. That's yours now. You're an owner. And step 8. The sell button. It's sitting right there in your account, usually one tap away from every stock you own. And I want you to know exactly where it is, not because you should use it, but because you shouldn't. That one button is about to become the most important thing in this whole video. So congratulations! You're officially an investor and own some shares. And that was the easy part. The market's going to climb, and at some point, it's going to drop. Hard. What you do in that moment matters more than any other decision combined. Remember what I told you was actually doing the work? Time. The snowball only grows because it keeps rolling, and selling in a panic does one thing to it. It rips the whole snowball off the hill. The money you lose that day is the small part. The years it needed to keep rolling are the part you can't get back. In that boring emergency fund from earlier, this is the moment it was built for. The person with a cushion gets to sit there and wait it out. The person without one has to sell at the bottom to cover rent. Same crash, same fund, completely different ending. Now, let me put real numbers on it, because this is those 10 days I promised you at the top. Picture two people, each with $10,000 in the S&P 500 back in 2005. The first one bought it and left it completely alone. And 20 years later, that money has grown to $71,750. The second one kept getting nervous. Out when things looked bad. Back in when they settled. And doing that, they missed the 10 best days of the whole 20 years. 10 days of about $5,000. Their investment grew to only $32,871. That gap is roughly $39,000. A car, a couple years of rent. For flinching 10 times. And it keeps going down from there. Miss the 20 best days and you're at $19,724. Miss 30 and you're around $13,857, which is 20 years in the stock market to end up behind what inflation took off you anyway. Here's the cruel part. Those best days almost never show up when things feel calm. About 76% of the market's best days happened during a downturn or in the first few weeks of a recovery. Right when everything looks awful and the panic seller has already run for the door, you can't catch the bounce if you sold before it showed up. But the story that really drives this home is COVID, and you probably remember this one. In February 2020, the market was at an all-time high. Then the pandemic hit, and in just 5 weeks, the S&P 500 dropped 34%. A third of everyone's money gone, almost overnight. For comparison, the 2008 crash took 17 months to hit bottom. This took 5 weeks. It was terrifying. So people panicked. They sold, and I get it. It genuinely for the world. But here's what happened to the person who sold near the bottom, say around March 16th, just trying to wait for things to calm down. 8 days later, the market jumped 9.4% in a single day. They missed it. That's one of those best days I just told you about, showing up right when everything looked hopeless. And the people who did nothing, who just held on through the fear, by that August, the market had completely recovered. By December, it was 16% higher than before the crash ever happened. Less than a year, the whole nightmare erased, and then some. Same crash. The only thing that separated the winner from the loser was one decision: sell or sit still. So it was never about being smart enough to time the market. You just had to be patient enough to stay in. Time in the market beats timing the market every single time. Now, the only question left is what you fill that account with and forget about. I narrowed it down to the one index fund, and it's projected to turn $7 a day, about what a sandwich costs, into a $2 million portfolio. That video is on screen right now.